Good afternoon, everyone. Thank you for joining us at today's Corporate Connect webinar featuring Pan United Corporation. This event is organized by SIAS and supported by SGX. Also, a warm welcome to those of you joining us via Facebook Live. My name is Zach, and I will be your MC for this afternoon. Today's webinar will start off with a presentation on recent market highlights by Mr. Jeff Howie, market strategist from SGX, and followed by a corporate presentation by Mr. Jim Tay, Group Head Corporate Development from Pan United Group. We will end off with a Q&A session that's moderated by SIAS. Now, a little quick background about Pan United Corporation before we begin. Pan United Corporation is the global leader in low-carbon concrete technologies, catalyzing change in the concrete space. Over 2 decades, Pan United has transformed into a technology company with deep domain knowledge and advanced digital capabilities. Pan United has pledged to offer only low-carbon concrete by 2030, offer carbon-neutral concrete by 2040, and to become a carbon-neutral company by 2050. Now, this afternoon, we'll get to hear more from Jim on the company's latest business updates. Now, before that, we would like to begin this webinar, and I would like to invite Mr. Jeff Howie from SGX to kick off the session on recent highlights. Jeff, over to you. Thanks.
Thanks so much, Zach. Let me just get my screen up. Thank you, and good afternoon, ladies and gentlemen. I'll provide a quick 10-minute overview on what's happening in our stock market. As we all know, we're home to a $400 billion trade-centered economy that has a stable political framework, international financial hub, strong infrastructure, and a host of, corporate attributes that rank very highly in global business efficiency surveys. While the Singapore economy booked a 3.6% GDP growth rate last year, the sluggish external demand that created that drag on growth in the fourth quarter of last year, as well as the modern services clusters, that has continued this year. So that drag mostly in trade-related clusters and modern services. Advanced estimates for the first quarter showed that we declined 0.7% year on year in the first quarter, but the full number will be out in the next couple of weeks. As reiterated by the IMF earlier this month, Asia is still, however, poised to drive global economic growth this year. This is going to be boosted by China's reopening, with the region contributing something like 70% of global growth this year. And this is much greater than we've seen in recent years. And overall growth in Asia and the Pacific is forecast to accelerate this year, actually up from 3.8% last year to 4.6% this year. The China-ASEAN bilateral trade, it has soared over COVID from $640 billion US to $975 billion US dollars last year. More broadly, China absorbs about a quarter of the exports from Asia, and the reopening and the growth of the economy is expected to generate positive spillovers to the region. However, there are 2 key reasons why we have not seen a snap recovery. Firstly, the global manufacturing downturn, which began to be priced in our stock market last year. This global manufacturing downturn has seen Singapore, South Korea, and Taiwan exports all in year-on-year contractions since October of last year. And secondly, China is obviously pursuing this more consumer-led recovery rather than a recovery. So I just wanted to touch on one point just to kind of give a little bit more broader overview for our broader stock market, because I think it's interesting that if the G20 was based on trade and not GDP, Singapore would be well within the G20. Currently, Singapore's gross domestic product is ranked something like around 30th largest across the globe. However, in terms of merchandise trade, Singapore is the globe's 16th largest exporter and the 16th largest importer by value. In terms of global exports and imports of commercial services, we rank even higher. We rank 8th largest exporter across the globe and 9th largest importer across the globe of commercial services. Singapore was also the 8th largest exporter of digitally delivered services last year, which is on the back, of course, of the I guess the digital communication very much taking a significant lead in Singapore's patent publications in recent years. If you combine the fact that also almost 40 cents of every dollar spent domestically in Singapore is actually on imports, then this is obviously why the MAS target of monetary policy is actually the Singapore dollar nominal effective exchange rate, that trade-weighted basket of currencies. But it also means that Singapore's stock market is one of the most diversified stock markets across the globe. When looking at more than 500 Singapore listed stocks that have generated trading activity this year, only some 140 stocks of those reported more than 90% of their last financial revenue to Singapore, while 230 stocks reported more than 50% of their revenue to Singapore. Revenue reach, it somewhat parallels these merchandise and service trade channels that we have, and Singapore lists more than 90 stocks that report more than half their revenue to ASEAN, excluding Singapore. And at the same time, we maintain 80 stocks that report more than half their revenue to mainland China. And there's also an element of diversification in the day-to-day trading activity in our stock market. Sure, as you can see here on the far left, 30 cents in the dollar every day goes to work in the banks, the 3 banks. 20 cents in the dollar goes to work in the S-REIT sector. 20 cents in the dollar goes to work in manufacturing-related stocks, which span all key 6 verticals of Singapore's industrial production. And then you have close to 10 cents in the dollar going to businesses that are pursuing sustainable infrastructure initiatives. And you'll be hearing more from Jim and Pan United, who is a global leader in low carbon concrete technologies, very soon. So let me just try and cycle through these slides as quickly as possible. The STI does maintain that 45% weightage to bank. Singapore banks have completed their first quarter of this year reporting and business updating. OCBC reported last week its first quarter net profit was up 39% year on year. For the 3 banks, after they reported record FY22 net profits that generated as much as 10 billion Singapore dollars in combined dividend distributions, the trio of banks reported these record net profits for the first quarter, with the ROE for DBS as high as 18.6%, which has been on the back of their significant digitalisation drive of the past 5-6 years. According to Bloomberg data, when you look at the trio of DBS, OCBC and UOB, they do maintain annualised return on common equity ratios that are above the median ROE for the top quartile of global banks by market value. Combined total income of the trio, that increased 36% year on year on combined net interest income growth and combined non-interest income growth. So basically year on year, you had the net interest income growth growing here in this March 23 quarter compared to the March of 22 quarter. But as you can see, when you're looking at the combined net interest income, which I should say does make up 2/3 of the total income of the banks, the combined first quarter net interest income for the trio was 8 billion in the first quarter. That's up from 5.4, as we said, back in the first quarter of last year, but it's actually down from 8.2 billion in the fourth quarter. Now, one key thing for this was that, yes, the pace of interest rate rises has subsided somewhat, but also this was a technicality in that we had a shorter quarter in the first quarter. We had 90 days in the first quarter of this year versus 92 days in the fourth quarter of last year. Usually you might have 1 day difference, but the 2 calendar days does make a difference when you add up and annualize all the actual net interest income. So basically net interest income was comparable to the fourth quarter with this first quarter reports that we've just had. Importantly too, it's not just about interest rates when it comes to growing net interest income, it's also about loan growth. And FY23 loan growth guidance is 3 to 5% for DBS. And similarly, it's low to mid-single digit percentages guidance for both OCBC and UOB. On the markets side, OCBC has noted its quarter-on-quarter rise in assets under management has been driven by new money inflows and positive market valuations. DBS has noted that it expects double-digit fee growth. UOB expects high single double-digit fee growth in FY23. So this is the non-interest income side of the total income, that around 32-33% of the total income. And DBS has noted its fee income, it was up year on year in Feb and March, reversing this year-long declines of with wealth management and investment banking recovering, and the pace of growth obviously looking forward dependent on market conditions. UOB noted quarter-on-quarter wealth management fees did rebound strongly from improved investor sentiments as well. And just to look at one more stock outside of the three banks, iFast Corporation, it also reported that while its first quarter assets under administration declined 3% from the quarter in the year before, from the first quarter of last year, the assets under management did actually increase 4% from the fourth quarter of last year. And we saw also last week iFast chair Mr. Lim Chung Chun acquired something like 22,000 shares in the company as well. Just to go on to my final slide, sorry. SDI so far this year, it has been led by Keppel Corp and Sembcorp in the year to date. Both stocks are among those group that have been pursuing strategic transformations in their business lines and obviously pursuing sustainable infrastructure initiatives. On the 20th of April, Keppel Corp announced its first quarter of this year revenue came into, I think it was 2.3 billion. That was up 9% year on year. So the energy and the environment part of its portfolio makes up around 70% of its revenue. Connectivity is 15%. That's co-location, the likes of M1 and Keppel DC REIT and so forth. So that's 15%. Urban development makes up something like 10%. And then you've also got asset management making up the balance. So you have those four core parts of the Keppel portfolio. Among its structural Vision 2030 initiatives, it is establishing itself as a leader in energy and environmental infrastructure and services, as well as its renewable energy portfolio has grown to about 2.8 gigawatts as of the end of March. Sembcorp as well has maintained 8.3 gigawatts of gross installed renewable capacity at the end of last year. It's on target to increase this to 10 gigawatts by 2025. And unlike conventional energy, renewable energy, it's not base load. It doesn't generate electricity 24/7. The power generation depends on the plant load factor of the renewable asset. So you can be impacted by irradiance for solar and wind resource measurements for wind assets. So what this means is that Sembcorp maintained that for its solar assets in Singapore, if that plant load factor was between 13% to 15% last year, and assuming that SP Group HDB flat average consumptions that have been published, 1 gigawatt of power could theoretically have powered over 270,000 four-room HDB flats in a year. So this is, as I said, this is a really important part of our stock market day-to-day flows so far this year. Cetrium's also obviously pursuing a renewable, cleaner, green solutions portfolio as well. And when you add all these stocks up that are pursuing sustainable infrastructure somewhat, they are accounting for almost 10 cents in the dollar that goes to work in the Singapore stock market every day. So I will leave here. Here's our QR code if you want more information on what we've covered. But I know everyone's here to hear more about Pan United, so I will stop sharing now and hand this over to Zach and Jim. Thank you so much.
Thank you, Jeff. All right, I hope everyone have gotten some great takeaway from Jeff's presentation on market highlights. Now, up next, we have Mr. Jim Tay, Group Head of Corporate Development, Pan United Group, to do a presentation on the company's latest business and financial updates. Now, Jim, over to you. Thank you.
Thank you. Good afternoon, and thank you, Jeff and Zach. Thank you again for SIAS and SGX for this invitation this afternoon. Today I will cover a few areas. One is introduction to Pan United. Secondly, our focus on technology and innovation. I'll spend some time on our views and our roles in decarbonization. And lastly, I will just go through on our quickly on our financials. Right. To start off, a bit introduction of Pan United. We are 65 years of history. We are listed on the Singapore Stock Exchange since 1993. Actually, this year is our 30th anniversary. Our core business is in the production and supply of ready-mix concrete. Our geographical footprint encompasses Southeast Asia, basically Singapore, Malaysia, and Vietnam. Our vision is to be the global leader in low-carbon concrete technology and anchored on concrete innovation and sustainability. Before I continue, maybe I'll just give a brief of what is concrete. To a layman, at times people think cement is concrete, concrete is cement. So just an overview of our business. Concrete production actually encompasses 5 key materials. One is cement, or what we call ordinary Portland cement. Secondly is aggregate. It's basically small 20 mm stones. Third one is sand. Fourth is water and admixture, the fifth. And all are imported in Singapore to Singapore by land and by sea, and be transported to our batching plants around the island. And there we will be mixed and produced and be transported through our ready-mix trucks to the concrete construction site. Our business, we are a very vertically integrated business. In Jurong Port, we have 3 silos with a 24% capacity in Singapore. We are the largest player of cement in Singapore, and we import ordinary Portland cement and ground granulated blast furnace slag. We also invested in a GGBFS plant in Johor. Basically, ground granulated blast furnace slag is a byproduct of the blast furnace steel plant. Some people call it green cement, and it basically is a substitute to ordinary Portland cement in the production of concrete. In terms of our ready-mix business, we are in 3 countries, Singapore being the largest. We are about 40% market share with our plants around the country. In Malaysia, we cover the key cities, one in Johor Bahru, KL, as well as Penang. In Ho Chi Minh, in Vietnam, in Ho Chi Minh, we are one of the largest concrete players there. Over the years, we at Pan United have invested a lot in people, products, and processes. And from there, we have continued to innovate. And 3 key innovations that I would like to share with you. One is primary products. We have invested in research and development. We have our own in-house team of material scientists and engineers, which help us adopt new technologies to continuously expand our product range. Today, in our portfolio, we have about 300 product range, concrete solutions. Let me give you an example of innovations in concrete, and something that is resonates very well with me. And so we actually work closely with National Cancer Center, where we developed a concrete called Pan Shield. Primarily, the concrete allowed us to produce concrete that are able to reduce and shield against the radiation ray in the National Cancer Center. And it's fantastic because that product itself helps to protect the daily lives of our healthcare workers. And that's what we do on a daily basis, continue to innovate and bring new products into everybody's daily lives. Secondly, in terms of process innovation, over the years, we have invested quite heavily in developing our own proprietary optimization platform that transforms our operation, where we acronym as AIR. It stands for Artificial Intelligence for Ready-Mix Concrete. Basically, it's a platform that we created for us to, of course, enhance our business as well as optimize our business. And lastly, we look at it as using technology to disrupt our business by incorporating things like mobility technology, Internet of Things, more data and cloud. With all this investment that we put in over the years, we start looking at business innovation. How do we monetize our core capabilities in intellectual property and domain knowledge? And we have continuously invested over the years, and from there on, we start developing new business model. I'm very proud that we have set up a company called Digital Solutions, where it basically offered software as a service or solutions to ready-mix players in the region. And if you look at it, example, maybe something like Oracle and SAP, and it's the same thing that we're doing now, right? We are offering our own digital platform, optimization platform to RMC players in this region. And if you can see that, we actually have 6 key modules, one in being raw material management, fleet optimization, fleet planning and management, quality control, customer relationship management, and even e-billings. So this is a package of how we offer it to our the RMC players in Singapore, in the region. In 2019, we go a step further to develop a company called GoTruck. It's a business-to-business supply chain and logistic platform for commercial vehicles in the construction sector. And now we are moving towards a software as a service business as well. So that's how, over the years from our investment, we continue to innovate into new business models. Just to summarize our a bit more better understanding how we do that is in terms of our core business. As you can see in the picture, I highlighted our upstream entities, our batching plants, and our customers' construction sites. And we start integrating technology into the whole supply chain and logistics and the business flow. With having GoTruck platform running our raw materials, continue innovating new concrete products like PenU Green and PenU mineralization concrete, and then incorporating an overarching concrete optimization platform. That's how we integrate our core business with technology as well as innovation. Next slide, I'll spend a bit more time on decarbonization in the built environment. Well, in Pan United, we sincerely believe that we have a role to play in decarbonization. Let me give you a perspective to this. Audrey Portland cement, which is a very key material in the building and key building material in the built environment, which is also a key material in the production of concrete. The material has been established since 18th century. However, it makes up about 8% of the global CO2 emission. And in the built environment, basically there are 2 types of carbon emission. One is operational carbon, which is carbon emission associated with the life cycle, ongoing operation of a building asset infrastructure. And that contributes 43% carbon emission in the built environment. However, the other part of it, which is embodied carbon, which is carbon emission associated with raw materials and construction processes in building an asset infrastructure of building. That constitutes more, which is about 50% of carbon emission. Hence, we sincerely believe there are huge opportunity for us to participate and contribute to the decarbonization, especially in the built environment. How we do it? Well, there are a few areas. Firstly, we look at the raw material itself. We look at sustainable raw materials. How are we able to replace natural raw materials with green byproducts? For instance, Audrey Portland cement primarily derived from limestone and a production process using coal. We have invested in our grinding plant in Johor over about 10 years ago, and it's operation now. And we're actually using the byproduct of a blast furnace steel. It's basically, and it's from blast furnace steel We grind it and we use it as a replacement to cement, ordinary Portland cement. Again, we use LNG rather than coal in the production of slags cement. Secondly, we look at how we source sustainable environmental technologies, how we incorporate carbon capture, utilization, and storage technology. Continue to invest in low carbon concrete technology in our business. Thirdly, we look at how we continue to innovate and start to look at low carbon concrete products. One of the key examples I mentioned is PenU carbon mineralization concrete. Primarily, the concrete is basically a process where we inject CO2 in the production of concrete. From there, we are able to increase the strength of the concrete, as well as reduce the consumption of ordinary Portland cement and concrete. Right. We continue to innovate like PenU Green, where we use a lot of recycled materials and sustainable byproducts as part of the concrete production. The fourth, which is very important, a collaboration with developers, contractors, and authorities. Work with like-minded people and authorities to continue to champion decarbonization. And when I say we are very blessed that, especially in Singapore, we have a lot of support from authorities like BCA, HDB, our customers like Jurong Port, Tuas Megaport, CapitaLand are continuously championing with us in this direction. As you can see, we have JTC Semiconductors, Tuas Megaport. Those are the parties that we work with continuously to champion towards that direction. On the fifth one is looking at process innovation, where how we reduce resources and manpower. With our optimization platform, we continue to look at how we reduce energy consumption and manpower resources. Lastly, but not least, is looking at waste upcycling. In our business, we use a lot of water. We obviously harvest water as well, and we use water, the harvested water or recycle our water used from washing of motor vehicles and use it back to our production, as well as harvesting water from outside to use in our production or washing of vehicles. The other part is more interesting, is that how we procure concrete that is not used or concrete that derived from pavement, repavement of roads, and we take back into our plant and we crush it again and use it as a recycled material in our production of concrete again. So this is interesting because that basically is a, well, you can call it like a cradle to grave concept, right? Yeah. The last slide on decarbonization, I would like to share, and I always like this slide because I always say that while concrete is everywhere, Pan United is also everywhere in Singapore. So on the left-hand side, just to give you a good example how we play our part. In February this year, we have announced that we will supply 360,000 meter cube of PenU carbon mineralization concrete for the Tuas Megaport project. It's for 2.5 years, and from that project, we will be able to reduce up to 114 million kilograms of CO2 carbon emission of embodied carbon. Into a layman, that basically reflects 24,500 vehicles off the road, and that's really interesting. And to be fair, it actually resonates with our Singapore Green Plan 2030, where we look at looking at green city, various targets, and continuously looking at new sustainable solutions, new facilities, and new infrastructure. Before I move on to the last two slides on financials, let me conclude on this slide is that we really feel there is a need to address climate change. I'm sure everybody feel the heat these days, right? Even Bloomberg mentioned that it's 37 Celsius in Singapore, right? In Ang Mo Kio, right? And climate change is real. Hence, it's inevitable that we need to decarbonize. So at Pan United, we sincerely believe we have a role to play and we have an opportunity to participate in this decarbonization, especially in the built environment. So let me move on to the last two slides. On terms of financial performance, we have registered about 703 million revenue for last year with a EBITDA of 51.5 million. I would like to summarize that this year and going forward, we still see that the construction sector remain robust. Obviously, for last 2 years and this year, cost of running business is still high, inflation is still high, but we are blessed that we're able to continue to maintain our EBITDA margin. In the last slide, on our financial position, our net asset value maintains at about 218 million. Our net cash actually is about 10 million for 31st December 2022. So in essence, we will continue to try to maintain at a 0 or minimum gearing level. And for this year, our strategy is always to maintain to be financially resilient, taking into consideration the current economic environment. Thank you very much.
Thanks, Jim. Thanks for sharing the business performance and financial updates with the investors here. So now I'd like to invite our Head of Research and Investor Education, Benjamin, to join us to moderate the Q&A session. Now, participants, you may input your questions in the Zoom Q&A box below. For our Facebook audience, please click on the link in the description box to join us here on Zoom to post your questions. We'll try to answer as many questions as we can before the end of the session. So over to you, Ben, to take over the Q&A.
Okay, thank you very much, Zach. Very warm welcome, Jim. We don't see you enough. Always very happy for senior management to join us in this sort of events.
It's a pleasure, Benjamin. I'm very happy to get invited.
Okay. All right, great. We do have a couple of pre-submitted questions, and as you have already seen, some questions have come in through the Q&A. So I'm going to curate and put them into the same category. So let's start with the business, the environment, so on and so forth. So there is a question here from one of our longtime viewers. I think this person, I guess, not so familiar with your company's business strategy. So this person wants to know what is Pan United's competitive advantages versus competitors.
Well, I think it's I always think that we our investors or public at large may have always misunderstood a company like us because we do a lot and we invest a lot in technology and sustainability solutions. And while our core business are always been in the building materials space, we have not just forgetting our core business, but we have always continued to innovate and grow our business and towards a direction whereby it involves a lot of technology, a lot of innovation, and a lot of sustainability in the forefront, right? Yeah.
Okay, sounds good. Very exciting to have a, I guess, I don't know, cement supplier, cement manufacturer to be investing so much in new technology.
Yeah.
Another question regarding the business model is, would you be able to share Pan United's market share in Johor, KL, Penang, and Ho Chi Minh City? I'm not sure whether you have the kind of segmented data on hand.
Our business in Malaysia is relatively small. As mentioned, in Singapore, we are primarily a largest player at about 40% market share. We are only in Ho Chi Minh today, and we are still one of the top 3 players in Ho Chi Minh today in concrete manufacturing and supply.
Okay. A follow-up question would be, if you look at the entire sales makeup, right? What is the percentage of your sales are generated from outside of Singapore?
Well, I guess if you look at it, Singapore is still our domain market, right? And historically and going forward, I think that will be still the same, because obviously also because of the currency. Today we are looking at about maybe 85 to 90% revenue being still generated in Singapore.
Okay. There were actually quite a few, and this is quite surprising, quite a few questions regarding I guess the unit price of your concrete products compared to other competitors, as well as the normal type. So the Singlish version would be, how expensive is your product compared to other products?
Well, thanks, Benjamin. It's a very good question. As always, we get a lot of this the same question. I'd like to say that we bring value to the table. That's the most fundamental thing. We bring value to the table, and we invest a lot in our business. We value in terms of technology. We are one of the first that roll out EDOs in the market. Our customers have daily upload data on supply, for instance. Yeah. So we always invest in technology, and also going forward, we also invest in products. We work closely with our stakeholders, our customers, and our authorities to develop new products to cater for continuous change in environment. So to answer short the question is that whatever we price is always value to the table. Yeah.
Okay.
And we are quite blessed. I think our customers also appreciate that. Right. Yeah.
Okay. Does that also include the green concrete that you were talking about?
Yes. Obviously, we if you look at concrete, there are various in the historical format, people always have a grading like G40, G50, and all that. But what we do is we build concrete solutions like PenU carbon mineralization concrete. We bring in PenU shield for National Cancer Center. So we always develop product, not that we don't want to do the run-of-the-mill solutions, right? Yeah.
Okay. So a question here is about whether or not customers see the additional value add of low carbon concrete versus the run-of-the-mill traditional style concrete. Is there a quantifiable economic value that customers can point to so that they will choose the green concrete from PenU compared to the normal type of concrete?
I'm glad to say that, and in our presentation as well, is that I'm very happy to say that in our built environment, we have seen very, very good traction in the environment. I say we have worked with very established developers. I mean, our environment like CapitaLand, Maple Tree, and so on and so forth. I mean, Joe, and I don't want to mention more names, but basically all the players are looking towards the direction. Our authorities are looking in the direction. As I mentioned in my presentation example, we have announced that we're going to supply 360,000 meter cube of carbon mineralization concrete to Tuas Megaport over 2.5 years. And that's fantastic. And that's announced in February. So the traction has been tremendous. Yeah.
Okay. So more questions about your green concrete. I think everybody is excited here because nobody has ever heard of green concrete. So just to clarify the technology behind this, when you mean concrete that minimizes the carbon footprint, are you talking about the production process, or are you saying that the concrete acts more of a carbon sink that will be able to absorb carbon from the environment?
I did mention how we do it just now. We can share a slide again, but primarily there are various areas. One is acting as carbon sink. like a carbon realization concrete where we inject CO2 inside. And that will help to reduce as in my colleague trying to share the slides. So there are various areas. I say first of all we focus on the input and converting the input to more sustainable byproducts rather than natural raw materials. And then we look at various technology like carbon capture, low carbon technology, concrete technologies, and then again products. And then to mention just now is like we continue we use the technology to enhance the processes to reduce consumption or resources like energy, manpower, right? And then go back, we upcycle the waste, the water, the materials that is not used, and recycle it to use again in our production, right? So it's a holistic approach to reduce carbon rather than one single focus, and that's what also keep us busy, lah. You know.
Okay. Okay, so sounds like it is the whole value chain. So you have got the production process, and also and also it acts as a carbon sink.
Yeah.
All right. So yeah. All right. Now the question again is the $64 million question is then it sounds like a pretty atas product, right? So then how does that affect your bottom line? Because I mean we are kind of surmising that in order to R&D this product and to produce it, it costs more than regular.
Yeah.
So is that true? And if true, then how does the company intend to bring down the cost of production so that it can be more competitive at the price level?
As I mentioned just now, first of all, the customers and stakeholders must see value in it, right? You can be atas or you call it that way. It's irrelevant if the stakeholders don't buy it. Yeah, right. Yeah. And then the stakeholders have to agree that it's a beneficial product for use and it's good for all of us, right? And then the result will show by itself. If you look at our numbers, I mentioned just now, I didn't go into details, but I did mention that we are facing an environment where there are high cost of doing business.
Sure. Yeah.
Costs, or cement costs, manpower costs, and we are able until today to at least continue to manage our margin to at this level, right? Maintain our margin, because in our business it's tough. Our margins are not high. It's not like a huge two-figure number, right? So we are unfortunately unable to subsidize all this, right? But we're able to continue to work with the customers, bring value to the table, and maintain our hopefully continue growing our profitability. Yeah.
Okay. So you touched on the high cost of raw materials. So this is relevant to some of the pre-submitted questions.
Yes.
So as you have already touched on, we are in an environment of high inflation, as well as perhaps a recession in the second half of this year. So how does that affect your business? How do you think that will affect your business as well as your markets?
Well, it's always we have been facing this issue for over a year plus, and to help us running the business, we have to leverage on technology, right? Yeah. And we are quite blessed that we have been investing in that over more than 10 years now, right? So our backbone in our business, where we have our own proprietary optimization platform, helps us a lot, right? We're able to optimize our plant, our fleet, in our doing business to reduce and to make it more efficient, right? In both manpower, energy consumption, utilization of vehicles, right? So that helps us to alleviate that increase a bit, right? Rather than let it run and not doing anything about it. So efficiency is always one of the, and of course, secondly is that we we as I mentioned to you, we have to bring value to the table. Yeah. So that itself will help us manage it. Yeah.
Okay. All right. There is a question here about how the company utilizes cash flow. If you could add a little bit of color as to how the company prioritizes cash flow between CapEx, OpEx, inorganic opportunities, maybe some M&A or corporate action, as well as dividends and shareholder returns. So how does the company make decision on this, basically the capital structure?
I saw that question, and it's a great question.
Yeah.
I'm a very cash flow driven person. Firstly, we look at our cash generation. Obviously, our business is a high working capital business. We will continue to manage that, and I think we have done it very well. We are generating cash. After the cash operation comes in, we always look at what do we need to do to sustain that cash generation, right? Rationale is basically we need to invest in CapEx, recurring CapEx especially. The plants continue running at the highest level, right? At most optimum level. There's no wastage. We also invest in people and technology, right? That's why in our CapEx, there's two parts. So one is the intellectual property side, and that's why it's the normal PPE side. After that, as of course, in concurrently, we have to use our cash to while we have zero debt, but we still have some term loans and these payments that we have to settle, right? After that, there'll be the free cash flows, what I call to shareholders, right? And from there, like last year, we have used the cash to pay dividends and even to do share buyback. I feel that's a very good form of return to shareholders as well. In terms of inorganic growth, whether it's M&A, and I'm very open to opportunities. We are very open to opportunities, especially sustainable technologies, right? Or technologies that really enhances and what we believe in decarbonization, right? I think what I can say today, while we are quite blessed that we don't have to prioritize organic investment and paying our shareholders. I mean, today we are near to zero debt. So today I'm not faced with that question today. But if I'm faced with that question, I always look at if I want to invest in organic growth, then the first question I'll ask myself is what is the cash generation of this organic growth, which must also complement back the return to shareholders, right? So that's, I hope that I answered that question.
Okay. Just now you touched on share buyback. Does PenU currently have a share buyback program?
Yes, we did. Last year we spent about 3 million on that share buyback.
I see. Okay. All right. So that is a good segue into our next two questions. So some of the investors on this call has noted that the trading volume of PenU shares is a little bit low. So I guess the question here is that are there any kind of catalysts or something that will increase the trading volume and hence the share price? And of course, you don't have to say anything which is private information, obviously confidential, right? But just in general, so share buyback is one.
Unfortunately, our shares I will call it well, we see quite tight held. I mean, you look at the transactions, there are not many buyers and there's not many sellers, actually, to be fair, right? So actually that's the real reason, there's not much sellers. So if you look back historically, we did also a huge rights issue back in 2017. I remember when I first joined. And that actually created a lot of shares in the market. But then after that, still again, the volume are still restricted. So obviously there's a lot of people holding to those shares, right? So we do sessions like this. We do share buyback. But the fact is that we are quite blessed that we have very good shareholders, I guess.
Okay. I do have a question, I mean, from my perspective. So I noted that the dividend, the last 12 months dividend yield for PenU is 4.68%, so slightly shy of 5%. But its 1 year dividend growth was quite impressive at 12.5%. So my question is, just now you talked about how you decide what to do with your cash flow, right? So with regards to dividend policy, do you see any kind of tweaks or adjustments, or what kind of dividends would we be expecting for the year ahead?
I can't say much on dividend this year because obviously the management and the board have not discussed about it, to be fair. What I can talk a bit about last year, the 4.6% is on cash. If you add the share buyback, it'll be about 5.6%, maybe something like that. Really our thought process in terms of dividends is basically the cash generation ability of the business. Yeah. And it goes back to the first question and that great question that I got about how we go through the thought process. It's a very structured process, you know. It's not like it's a process of how much we generate, the discipline that we have in our business to generate, and what do we use to continue to use to generate the cash flows in the future, and then going back to the shareholders. So it's a very consistent approach. Yeah. Obviously, we do have a dividend policy, you know, it's a wanted, but that is just a guiding principle.
Sure.
Yeah. And historically, I would say that I mean we have been consistently with our dividends even when they're not doing so well. Yeah.
All right, fair enough. So related to what you touched on about the relatively low free float. So there is a question here: what is the free float of PenU? And unfortunately, I can't find it on my Bloomberg terminal.
Well, 25%. 25%.
About 25%.
Yeah.
All right, good. So it's always good to talk to the man in charge, right, and look up a terminal. All right, so okay, so thank you so much for that. And that concludes our questions. We run out of pre-submitted questions as well as questions that have been submitted live. Thank you so much for answering all questions. We always love a candid response, and we hope to see you more often.
Thank you, Benjamin. Thank you, and thank you, Zach. Thank you, SGX as well on the invitation. Yes.
Okay, Zach, I'm going to pass the time over to you. I'm not sure whether you've got any closing slides or remarks.
Sure. All right. Thanks, Ben. Thanks, Jim, for going through all the questions and answers thoroughly for the benefit of all the investors here. So we have now come to the end of this session. Thank you, everyone, for taking your time to join us this afternoon. In case you missed any part of today's session, you can actually rewatch the webinar on SIAS YouTube channel. Now, Corporate Connect is a bi-monthly webinar. Do visit our website to get updates on our upcoming investor education programs and initiatives. The upcoming Corporate Connect will be featuring Lendlease Global Commercial REIT on 23rd May. Please register your seats if you have not done so. Thank you once again, and hope all of you have a great day ahead.
Thanks, Jim. It was a pleasure speaking to you.
Thank you.
Thank you.
Thanks for the invite. Thank you very much. It's a pleasure.